Welcome friends. In this video we are going to start with inter interest rate risk management. So chapter 12 in AFM subject. So CA final. So what we learn from this chapter: benchmark rates, interest rate risk, hedging interest rate. So how we can hedge in traditional method and modern methods. This will include interest rate derivatives. This is the concept we will learn from this chapter. So here the companies with low profit margins and which have high capital expenses may extremely sensitive to interest. Because why banks there, if banks are giving loans to companies, if the interest rate was increased, so they need to pay the more interest. So when the company is paying more interest, its operating expenditure will increase. So when operating expenditure is increasing, net profit will affect. So this will affect the company. So increasing the interest, it will affect the company. So the company has how sensitive interest rate increases. Here interest rate derivative means the contract which have changing value and based on underlying assets. Here derivative can be used as a tool to manage the risk. So for this interest rate, they are using the derivative to uh, manage that risk. So interest rate risk is there for company to manage that risk. They are using the derivatives. So derivatives are powerful tool to mitigate and build value. They have companies to develop risk mitigation strategies. So for interest risk, they are using the derivatives. Now interest rates will either cost borrowing company and compensation for services and risk lending money. Here interest are always changing. It have different loan offers for different loan interest rates. So the lender means here the bank who is giving money takes risk because borrower may not pay back the loan, or does interest provide a certain compensation for bearing risk. So here what they are telling, sometimes we can borrow money, sometimes we are giving the money. When if you are giving loan to other persons, if that person is not able to pay that debt, it will borrow companies bear the risk that time also. Next, coupled with the risk of default of the risk inflation. So inflation risk. So another risk will be inflation. When you lend money now, the price of the goods and services may go up by the time or you paid back, or so your money originally purchasing power would decrease. So when you are giving any loans, so you are lended some loans, then you do not have the money. When you do not have the money, the goods which are purchasing by you, the price was increased, then your purchasing power will decreased. Then if it want to protect against this future rises inflation, then we need to use the derivative. So firstly, for inflation risk, to avoid inflation risk or to avoid interest rates, we are using derivatives. So what are the factors will affect the interest rate are largely macroeconomics in nature, sir, where reasons for increasing the interest rate, one must be demand and supply of money. Because of demand and supply of money, interest rates may go or down. So when economic growth is high, demand for money is high, increasing. So when demand is increasing for money, then interest rate will increase. So if the companies are going more loan for with the banks, then banks may increase the interest rates. So one is the reason for demand and supply. Another one will inflation. So higher inflation rate is there, then higher interest rates will be raised. And other factor will be government is the biggest borrower. The level of borrowing also determine the interest rate. So for example, central government, that is RBI, either printing more notes or through its open market operation changes the key rates, that is CRR rate, SLR rate and bank rates depending on the states of the economy or combat inflation. So what are the factors will affect for the interest rate? One is demand and supply money, another one is inflation, another one is government decisions. Next, firstly we need to see that benchmark rates. So here the benchmark rate means one ideal rate, so one standard rate also. So benchmark rate, here benchmark rate, benchmark interest is an interest rate that form the basics of determination of other interest rate. So based on this ideal, so one person is there, this is ideal person. If any company one person is working in a good manner, then any other person is came to, they will show this person, so take suggestion from that person. This is the ideal person, this is the benchmark person. So same like as for interest rate, we have benchmark rates. That benchmark rate is known as reference rate. The rates are very important in any economy and banking system. So especially these financial institutions, interest rate is the main, so that they will refer the rates from different areas, because the interest rates in banks, different products will be there in bank. The products may be based on bank overdraft, loans, mortgages, but also used in other complex financial transactions. The benchmark rate are will be used in derivative transactions also. That is, in derivative we have forwards, futures, option contracts, or especially the swap contracts is there, where swap contracts means here we will exchange the series of cash flows, where we have exchanging the interest rate. You are paying in fixed, you want floating, you can exchange, you, or we can go for the currency swaps. You are paying in rupees, we want to go for the dollars, or we have total return swap, TRS swap, so we will swap the change. So here swap means exchanging. So swap contract, these are also the benchmark rate will be used. The benchmark rate also forms basis of floating loan rates. Generally relating to this credit rating, who will provide the credit rating? Credit rating will be provided by the these credit rating companies, Moody or Credisai or Crisel. These all companies will provide the credit rating. Based on this entity's base point will be considered, and based on that base point they will provide AAA plus or B plus or C category, they will provide the and above. Or now some questions will arise for you: who will decide the benchmark? The answer is that rates are decided by the independent body after considering the various factors. So the benchmark will be decided based on the different various factors will be considered, where in financial transaction both domestic as well as international benchmark rates were used. Mostly these benchmark rates are international financial rates, where we have LIBOR means London Interbank Offer Rate. However, after coming the news manipulation by some banks in 2012, it was finally decided to it will cease to exist. So means come out from the there, they will considering different rates. They are using ARR rates. So normally we are following LB or LIBOR rate, but from 2012 we are using different rates also. They are ARR, that is alternative reference rates. Here different from the LIBOR because the following rates. What is there in the ARR, while AAR are based on the actual overnight transactions, either secured or unsecured. LIBOR is unsecured without any collateral and mainly relies on the judgments. So of the panel banks to great extent. ARR are also considered here mainly relies on judgment panel to great extent. So this will see without any collateral, without any relay, they will focus on relies on judgments and the overnight or actual overnight they secured unsecured. And ARR is also considered to near risk free rate, that is RF risk free rate, where we can see this risk free rate mainly in government investments. So with no term of premium, they do not also use the premium for without giving the risk there. Here another question will arise, where this which ARR should be used for benchmark rate, which is the alternative to LIBOR. So LIBOR alternative we can use. The answer lies in the fact contrary that single L LIBOR are different currencies. The LAR shall different names, regulator and natures. So different will be there. In addition to this, the basis of geographical referred location. So for where we have different areas now, for different countries, different rates will be there. In USA they will use SOFR rate, that is so secured overnight financing rate, and where it was regulatory by Federal Reserve Bank of New York. So it will it will be in nature, it will be secured nature. And after that we have in UK Sonia. So Sonia Sterling overnight index average rate. Here it will be regulated by Bank of England and it will be in unsecured. And after that Euro short term rate. Euro short term rate, it is European Central Bank where it is unsecured. So Tokyo overnight average rate toner, so it is Bank of Japan which will be unsecured. And Switzerland, that is Swiss average rate overnight, this is will be regulated by 6, that is Swiss stock exchange will regulator, the nature will be secured. So in Libor means London offer rater, where we will use different rates. In India we have the benchmark interest rates, means that repo rate, primary lending rates, and MCLR rate, that is marginal cost of lending rates, etc. But most of the common benchmark rates are MIBARs. So we can use a MIBAR or MIBID, Mumbai Interbank Bid Rates. While MIBAR is that interest rate at which bank will charge from the borrower, the MIBAD is that rate at which the bank would like to borrow from the other. So if you are borrowing money, means interest rate where from borrower, so they will charge from the borrower, that is MIBAR can be used. Where borrower from other bank, then MIBID will be used. There are two rates will be there na, that one rate interest rate swaps, forward rate agreements, and floating rate debentures. Majorly these derivatives will be the type of rates. For this also important that not only benchmark rates are used in various types of financial transactions, they may use different rates also. So some cases they can use the fixed rates. So in interest rate we have different types of loans: LIBOR, MIBOR, SONI, SOFR, or interest inflation fixed rate, inflation plus 2%, LIBOR plus 3%. So different interest rates will be exist in the country. And interest rate risk. So what is the interest rate risk? So we are already told that interest is the sensitive information for the bank. When interest rates are increasing, the company will get the fear, because the interest rate is increasing, they need to pay the more expenditure, more amount they need to pay, operating cost will be increasing, finance cost. Here the interest risk is the change of the price of the bond would occur because change in interest rates. So interest rates are changing, interest risk is increasing, where here we need to consider the impact of interest income due to change in rate of interest. So if you are invested in some bonds, then you will get the interest income. So in other words, prices as well as reinvestment risk also we need to focus. So for interest rates for fixed deposit, banks incur interest rate risk. They should make gain or loss with every change in the level of interest. What are the types of interest rates? So in companies or other interest rates risk, various types of interest rate risk faced by the company or bank. For what are the risks faced by the bank? So first risk will be gap exposure. Here a gap or mismatch risk arises from the holding assets and liabilities of off balance sheet items. Here whatever the asset they are holding, whatever the liabilities they are holding, whatever the off balance sheet items means that when you have some loans, you are sent to other persons, your securitization process, you are sent that your asset to SPV, that is off balance sheet items, with different principal amounts or maturity or repricing dates. They create exposure to unexpected changes in the level of market interest rates. So this exposure is more important in relation to banking business. So gap exposure is the first risk. So because of there is gap between the principal amount, maturity dates, repricing dates, etc. Next, where the positive gap indicates that banks have more interest rate sensitive assets than interest rate insensitive position. So positive gap, when will be the positive gap? When we have more RSA, that is interest rate risk asset, then interest rate risk liability. So assets is more than liability, then it is positive GPA. Here a positive or asset sensitive GP means that in increase in the market interest rate could cause an increase in net interest income. Conversely, whereas negative or liability sensitive gap implies that the bank or NII, that is net interest income, could increase as a result decrease in the market interest rates. So if you have negative gap, it will indicate more liabilities is there than RSS. So the gap is used to is a measure interest rate sensitivity. Here whether positive or negative gap, we need to multiply with the assumed interest rate changes to derive the earnings at risk. So EAR, earnings at risk. For calculating the earnings at risk, we need to multiply with that rates. Here year method facilitates to estimate how much earnings might be impacted by an adverse movement in the market. What will year explain? Year will explain what is the amount. So what is the earnings you can get at the time of adverse interest rate. So in the market interest rates are high, at that point what are your earnings will indicate this year. So year method, year means earnings at risk. The changes in interest rate could be estimated on the basis of past trends forecasting of interest rates. So how the changes will happen in interest rates based on past trends, what is the trend is there in past, what is the forecasting interest rates is there, what is the country situation, these all are depend based on this interest rates are changing. The bank should fix a AR which could be based on the last or current year's income, and trigger point at which the line management should adapt on or off balance sheet hedging strategies should be clearly mentioned, where we need to identify that gap calculations. So for gap calculation can be augmented by information and the average coupon on assets or liabilities in each time band, and the same could be used to calculate estimates of the level of NII. NII means that net interest income. So for this NII means net interest incomes. So we need to, what is the position of this NII, we need to calculate the estimated level of NII. We need to calculate when position at maturing or due for repricing within given time band. Here which would then provide a scale to assess the changes in income implied the gap analysis. Gap analysis means what? Here we need to calculate the augmented by using the information, we need to calculate average coupon on assets and liabilities at each time, and we need to calculate that estimated NII, level of NII. So here NII means net interest income, we need to calculate. This will gap analysis. Here what is the periodic gap analysis? So gap analysis indicates interest rate risk exposure of banks over distinct maturities and suggested magnitude of portfolio changes necessary to alter the risk profile. So periodic gap analysis we need to consider whether monthly or quarterly, we need to calculate. By calculating that we know the distinct maturities and what are the suggestion magnitude of portfolio, what are the changes altered to risk profile we need to consider. So although the gap report is very useful for analysis of risk, but it also suffer from following limitations. What are the limitations will be there for gap report? Gap report will be, it is quantifies only the time difference between the repricing date of asset and liabilities, but fails to measure the impact of basis and embedded option risk. So it is able to, it is give the information, it is give the reason for difference between the repricing dates of asset and liabilities, but it is failed to impact the basis of, and basis means spread, that is where the spot rate minus actual rate, it will be basis. And embedded option risk, we need to see that embedded option risk also. Next, the gap report also fails to measure the entire impact of a change in interest rate. So it is not able to measure the entire impact if the changes are there. So gap report assume that all assets and liabilities are matured or repriced simultaneously. So on the basis of that assumption, it will possible to calculate. So if there is any change, if it is any change in interest rate, it is not possible to measure the gap report. So within the given time band and effect of changes in interest rate on economic or market value of assets and liabilities or of balance sheet positions, it will not consider. Next, it also does not take into account any differences in timing of payment that might occur as a result of changes in interest rate environment. So here also, if there is any timing difference on payments, so timing difference in timing of payments, then also it is not able to report gap report. Further, assumptions of parallel shift in yield curves seldom happen in the financial market. Next, assumptions will be, so parallel assumption, what is the shift, parallel shift in the yield curve. Next, the gap report also fails to capture variability in non-interest revenue and expenses, a potential important source of risk to current income. Now, what is the basis risk? So, for basis risk, market interest rates of various instruments seldom changes by same degree during a given period of time. Here, the risk that the interest rate of different assets, liabilities, off balance sheet items may change in different magnitude is termed as basis of risk. So, basis risk means what? What is the difference between the risk that the interest rate of different assets, liabilities, or off balance sheet items with different magnitude? It will be known as basis risk. For example, you how assets may be at benchmark at fixed rate. So, one asset is there. Asset, how can we daba? I don't know. I think so. This is one asset. So this asset is there. Here the asset benchmark to fixed interest rate and liabilities may be benchmarked to. So these assets will be fixed. Liabilities will be floating. Will be there. Here benchmark to floating rates. The degree of basis risk is fairly high in respect of bank that create composite asset out of the composite liability. So we need to see the, for composite asset and composite liability, what will be the risk. The loan book in India is funded out of composite liability portfolio and he is exposed to considerable degree of basis risk. So what is the basic risk is quite visible in volatile interest risk scenarios. So now, where if there is any variation in the market rate, it will cause us to NII, that is net interest income will affect when there is variations in basis risk. The banks have experienced favorable basis shifts, and if the interest rate movement causes to net interest income, the basis has moved against the banks. Now we need to see about embedded option risk. Here embedded option risk means significant changes in market interest rates create another source of risk to banks profitability by encouraging prepayment of cash credit or demand loans or term loans and exercise of call option or put options on bonds or debentures and premature withdrawals of term deposit before the stated maturities. And embedded option risk is being a reality in India and is experienced in volatile situation, the faster and higher the magnitude of changes in interest rate. So here the embedded option means if you have one watch, so for this watch we are attached one diamonds. This is embedded. So embedded will be there for this watch. Embedded option means one for the host contact it has one other contact is attached, that is embedded contact. Here the embedded options will be there, that embedded option risks will be discussing. So what we are discussing actually, we have risks will be there by various types of interest rate risk we are facing. First risk will be gap exposure and another will be basis exposure, that is different as in different markets, different market interest rates are different basis risk, that is spot rate is different future rate, that is basis risk. And another one is embedded option risk. Here significant changes in market interest which create another source of risk to banks profitability by encouraging prepayment of cash credit or demand loans or term loans and exercise the call or put options. So now for that call or put options on bonds or debentures and premature withdrawals of term deposits before the stated maturities. Here, the embedded option risk is becoming a reality in India and is experienced in volatility situation. So, the faster and higher the magnitude of changes will be provided, the greater will be embedded options risk of bank. So NII will be considered here also, that is net interest income will be considered. So the bank should evolve scientific techniques to estimate the probable embedded options and adjust the gap statements. What are the gap statements? They will adjust liability and interest rate sensitivity to realistic estimate the risk profiles in their balance sheet. So bank should also endure to stipulate appropriate penalties based on the opportunity cost to stem the excess option, which always to the disadvantages of bank. Next, yield curve risk. Here, yield curve risk, the movements in yield curve are rather frequent when the economy moves through business cycle. Thus, banks should evaluate the movement in the yield curves and its impact on the portfolio values and income. So, yield curve risk means yield YTM, yield to maturity will be there na, that curve risk is there. So rather frequently when economy moves through business cycle, so in business cycle economy will moving, that economy moving will affect the yield curve. Yield curve is affected, interest rate risk also affected. The bank should evaluate the momentum of yield curve, and sometimes yield curve will be inverted yield curve, so it will impact the portfolio values and incomes of the company also. Next, another risk will be price risk. Here price risk occurs when assets are sold before the stated maturity. So for example, you have one asset, so asset maturity will be 10 years, but the company is sold before 5 years only or before 6 years only, but at low prices. So in the financial market we have bond prices and yields are inversely related, that is inverted yield curve will be there, we are discussing now that one. The price risk is closely associated with the trading books, which is created for making profits out of short term movements in the interest rates. So we need to see the short term or long term interest rates also affect the interest rate risk. So bank will have active trading books, should therefore formulate policies to limit the portfolio size, holding period, duration, defense period, stop loss limits, marking to market. So these all will be considered. Now what is this? So for this, bank should refer the formulate policies to limit the portfolio size. Portfolio size means whatever the amount you are committed and whatever the amount you are provided now, that will be size. So for the bank have some amounts, active trading amounts, that is size. Holding period means they are given 3 months, 4 months, how many months they are holding from past they are holding, what is the duration, how many years to go to maintain, how many years to go to hold that amount, or defense period or stop loss limit. So stop loss limit means in stock market where the amount, if you in we can use the, in stock market we will use the stop loss limit, where we can use this stop loss limit to loss, to maintain the loss, where we can use this loss, we can mitigate the risk of changing interest rates in a dynamic nature. So if you are entering into stock market, if you want to buy any stocks, so at the time of buying, if you put the buy, the prices will be changing in a real time basis. So to stop that loss, we need to use this stop loss limit option. And marking to market, marking to market means here in stock market we have daily settlement option. So in daily settlement option, if you have any contract value, we should not pay the full amount. If for example, we have contract value 1 lakh, for contract value 1 lakh we need to pay just margin amount. So that margin amount will be 20% will be there, or 15% in some cases. So whatever the margin value we need to pay, at the end of the day to day they need to collect some amount from different amount whatever the market is traded. So for example, the market is opening at 9:15 a.m. and it will end on 3:30 p.m. So if at 3:30 the amount was increased, means you need to pay some amount, and it will stock exchange will pay who will gain that amount. So they will go with the daily settlement, marking to market. That is the case. And after that, reinvestment risk. Reinvestment risk means here uncertainty with regard to interest rates at which the future cash flows could reinvested is called reinvestment risk. So any mismatch in the cash flows would expose the bank to variations in NII has the market risk. So reinvestment risk means, for example, if you take an put option by example, I think put option buyer will get rights, I think so. So it is call option. For example, call option, company will get the right. What will happen in call option? In company here, so company may pay whenever they have money. So for example, it is 5 years bond. For example, it is 5 years bond. You are invested in 5 years bond, it as call option. When at the time of 3 years, the amounts interest rate in the outside market that was decreased. So company is paying 10%. So outside banks are giving at the time of bond issue, banks is charging 8 to 8%. Now banks decrease the interest rate, so 6%. What company will do? Company repay this amount to all its debenture holders. They will borrow from the bank. They will pay the less interest here. Now these investors need to invest in some other place, or they don't buy the investors immediately. If they went for the bank, they will have less interest as compared to companies paying. This is reinvestment risk. So when amount is matured, that amount is going to invest in other place, so there may be interest rates is fall, that will be affected. So that is reinvestment risk will be there. And after that, so we have completed the risks. Types of risk will be there in interest rates. One is gap exposure, one is basis risk, one is embedded option risk, one is yield curve risk, one is price risk, and one is this reinvestment risk. Now we need to measure the interest rate risk. Before this interest rate risk, we could manage or we should identify the quantified. So here quantified, unless quantum of IRR means internal rate of return, weighted means we will see the weightage here in the balance sheet is identified. It is impossible to measure the degree of risk to which banks are exposed, so it is not easy to identify. So for example, one bond is giving 10%, another one bond is giving 8%. It is only for 1 year, it is giving 8%. It is 1 year bond, it is 2 year bond. If we see interest rates, by seeing interest rates, we will choose this one because it is giving 10%, means as compared to this we are getting 2% extra. It is, if the time we see, it is only 1 year. So within 1 year it does not, we need to wait another 1 year, so that they are paying more interest. So when company has more paid, means more time they are giving, risk is there, so they will pay the more interest. That only they are telling. So that for this, so when this have different rate for different timing period, you need to identify the IRR rates will be considered. So IRR rate will be considered to take the decisions. Now it is impossible to measure the degree of risk to which bank are exposed. It is also equally impossible to develop the effective risk management strategies or hedging techniques without being able to understand the correct risk position of the bank. So for the correct risk position to identify, we will use the IRR measurement. Here bank should address all material sources and interest rate risk, including gap or mismatches or whatever the risks is there na, gap mismatch or basis risk or embedded options or yield curves or prices risk or reinvestment risk or net interest risk position exposures, whatever the risks is there, they will consider all these risks. So here, the IRR measurement system should also take into account the specific characteristics of each individual interest rate sensitive positions and should capture in detail the full range of potential movement in the interest rates. Here, it may use different techniques to measure the interest rates rate risks. So range from traditional maturity gap analysis to measure the interest rate sensitive of earnings durations or simulation of VAR. So they may use the duration or they may use the value at risk, they may use the another method. So to identify different techniques will be there to measure the interest rate risk. So they will consider this one. Further they will identify the interest rates risk. So by identifying the interest rate risk, it is better they will form the decisions. So here whatever they are considering, we need to hedge the interest rate risk. So we have identified some risks. So different types of risk we are identified now. Now we need to hedge that risk. So how can we hedge the risks? This is the main question here. So for hedging the interest rate risk, we have two methods. One will be traditional method, another one will be modern method. In traditional method, we have assets and liability management, and another one will be fixed rate of interest. So I think just a second, fixed rate of interest. 2 seconds here, better. Okay, come to the point. So in traditional method we have use one, and in modern method we can use another one. So in traditional method we have two classified into two categories. One is asset and liability management, and another one is forward rate agreement. Another method will be modern method. This method are further classified into following category, that is interest rate future, interest rate options, interest rate swaps. Swaps means where we can exchange the cash flows. Now traditional method. In traditional method we will know about asset and liability management. So ALM, asset and liability management, is one of the important tools of risk management in commercial banks of India. So here Indian banks industry is exposed to a number of risks prevailing in the market. So what is the bank accepting deposit when interest rates are low and giving loan when rises? So here banks are accepting the loans, interest rates are low, and give loans when it is rises. This is the industry trend. The Indian bank industries are exposed to number of risks will be there for in bank industries also. What are their risk? The risk may be market rate, financial risk, interest rate risk, different types of risk will be there. So that the net income of the bank is very sensitive to these factors or risk. For this purpose, RBI will, the regulator of Indian bank industry, evolved the tool known as ALM. So asset limited management will be used to, it is a tool which can be used to risk management in commercial bank of India. Now ALM is comprehensive and dynamic framework for measuring, monitoring and managing. So for measuring, monitoring and managing the dynamic framework, the market risk of a bank, it is management of structure of balance sheet, liabilities and assets in such a way that the net earnings from interest, what are the net earnings from interest, are maximized within the overall risk preference, that is present, what is the present and future of the institutions. ALM functions extended to liquidity risk management and management of market risk, or trading risk management, or funding and capital planning, profit planning and growth projections will be considered. So for ALM, what we need to consider, ALM means asset and liability management. We need to manage the assets, we need to manage the liabilities, because we have different types of risk. For that we are using this ALM. ALM is a one framework which can measure or monitoring and managing the market risk of bank. It is one structure, management of structure, which has balance sheet. In balance sheet we have liabilities and assets in such a way that net earnings from interest are maximized with overall risk preference. So what is the present, what is the future of the institution, based on that they will consider the risk. So in here whatever the risk they will consider, and the concept here ALM functions extended to risk liquidity risk management or management of market risk or trading risk management or funding and capital planning and profit planning and growth projections. So the concept of ALM is of recent origin in India. So it has been introduced in Indian bank industry, that is which effect from April 1st April. So from sorry yaar, from 1st April the ALM concept with 1st April 2019 it was introduced. It is risk management and provide comprehensive and dynamic framework for measuring, monitoring, managing the liquidity risk for banks and other financial institutions who are providing services which have different kinds of risks will be there. There may be credit risk, interest risk or liquidity risk. So asset limited management is an approach that provides institution with protection that makes such a risk acceptable. So asset liability management model enable institution to measure and monitor risk and provide suitable strategies for their management. If it is therefore appropriate for institutions, so the institutions may be banks, financial companies, leasing companies, insurance companies and others. So they need to focus the ALM, that is asset limited management. So they need to focus when they face financial risk of different types. Here ALM include not only formalization of this understanding, but also way to quantify and manage these risks. So further, even in the absence of formal asset liability management program, the understanding of this concept is of value to an institution, as it provides a true picture of risk reward trade-off in which the institution is engaged. Here ALM is the first step in the long-term strategic planning process. Therefore it can be considered as planning function for intermediate terms. So in a sense the various aspects of balance sheet management deal with planning as well as directions and control the levels, changes and mix of assets, liabilities of the capital. So we need to consider the planning functions for intermediate terms. Next, another one will be FRA. What is this FRA? Means in we are discussing hedging interest rate risk. So to hedge the interest rate we have two methods. One is traditional method, another one is modern method. In traditional method we are further classified into asset liability management, and another one will be FRA, that is forward rate agreement. Here this is one agreement between two parties. So one party is there and another party will be. In between of these two parties will have one agreement where borrower or lender protects itself from the unfavorable changes in the interest rate. So when there is interest rates are changing, to protect themselves they are entering this FRA. FRA are not traded on any an exchange, thus are called OTC product. So what are the features for FRA? Forward rate agreements. Here normally it is used by banks to fix interest cost on anticipated future deposits or interest revenues on variable rate loans indexed to benchmark interest rates. So benchmark rates means this LIBOR or MIBOR etc. Here what they are telling, so banks will use the fixed interest rate cost because they will anticipate future deposits or interest revenues or variable loans which will be indexed to benchmark rates. So and it is an off balance sheet instrument. So FRA means it is off balance sheet instruments where For FRA feature, first one will be bank's fixed interest will be there and off balance sheet item, and it does not involve any transfer of principal. The principal amount of the agreement is termed notional because this notional means principal amount, nothing but principal only, where it is settled at maturity in cash representing the profit or loss. A bank that sells an FRA agrees to pay the buyer and increase interest cost on some notional principal amount if reference rates of some specified maturity is above a stipulated forward interest rate on the contract maturity or settlement date. Conversely, the buyer agrees to pay the seller any decrease in interest cost if reference rate falls below the forward rate. Finally, the FRA formula will be N into RR minus FR into DTM by dy. So we are discussed all the terms whatever here there. N is notional amount. Notional amount means principal amount. RR, this is reference rate. We are started with benchmark rate. Now benchmark rate is also known as reference rate. And FR, this is forward rate. This forward rate. DTM by dy means whatever how many number of days will be there divided by full year and divided by 1 plus R means reference rate into 100. So what we are discussed, they will be formula will be there. So notional principal amount agreement reference rate for the maturity agreed upon forward rate maturity of the forward rate specified date. So how many days we are completed and divided by 365 date counts. So money to market. For this we have one concept will be there. What is the concept? Day convention concept. So for day convention concept means act to act basis. So they are provided this 360 or 365 na. If you go for the month January it will have 31 days, February it will have 28 days, and for example we will take April, it will be have 30 days. So normally we will take 31 divided by 365 or 360, 28 divided by 365 through 360, or 30 divided by 365 or 360. But for the convention what the company they do now, so for this they will not consider these dates. So they will mention for every month we will consider as 30 days only. So for January it is 30 days, they will consider 30 divided by 360 or 365, and February 30 divided by 360, and for April that is 30 divided by 360. It is day convention concept will come into the picture here. Here reference rate is RR rate. So RR rate is greater than FR rate. Reference rate is greater than FR, then seller owe the payment to the buyer. So here who will be there? Seller is need to owe to the payment to the buyer, owes to payment to the buyer, where if reference rate, for example I will take here only, if reference rate is less than the FR rate, so reference rate is less than the FR rate, then buyer owes the seller the absolute value of the payment. So here buyers owes, where FR greater than means seller owes. This is they are explaining here. Now the differential amount is discontinued at the post changes, that is actual interest rate. It is settled in the beginning of the period, not at the end of the period. For example, they are providing one example. So I will explain this example here. I think that here it is better. So what is there in here? So they have two banks will be there. They have in bank they have agreement is there. Agreement what they are telling, forward rate is there at 5% will be the forward rate, that is on euro dollar, which is deposited in 3 months maturity the rate, and after that they provided $1. So $1 million amount is there, that is notional principal amount N amount, and where has settlement for 1 month. So settlement will be 1 month. This is the example they provided here. So forward rate 5%, euro dollar deposited with 3 months maturity and 1 million notional principal and settlement in 1 month. Such as an agreement is termed as 1/4. So 1/4 means 1 month after for 3 months loan. So 1 month after 3 months loan. 1 cross 4 means what? 1 month after for 3 months loans. So they, because it fixed the interest rate for deposit to be placed after 1 month and maturing 4 months after the date of contraction negotiations. So 1 cross 4 means here 1 month after it has 3 months time. So the contract period will be 3 months. It will be entered after 1 month. Now in 3 months, what is the labor rate? 6% will be the labor rate on the contract settlement date. The seller would owe the buyer the difference between 6 and 5% interest on $1 million for a period of 90 days. So every 1 basis point change in the interest rate payable on principal of $1 million for 90 days. So maturity changes interest cost by $25. So that increase in the interest cost on 3 months euro dollar deposit over the specified forward rate. In this case, $25 into 100 basis point, 2500 is the amount. So the $2500 difference in the interest cost calculated above is discounted back 3 months using the actual 3 months labor prevailing on the settlement date. Thus 90 days labor turns out to be 6% on the contract maturity date. The buyer would receive 2463, that is equal to 2500 divided by interest rates, whatever the interest rate is there, 6% interest rate into 90 divided by 360 days. Now another method will be, so we have completed 2 methods under traditional method. So traditional method have assets and liability management method and forward rate agreement. So another will be modern method. In modern method we have 3 categories. One is interest rate future, another one is interest rate option, another one is interest rate options. So first is interest rate future. What is there in interest rate future? As per Investopedia, so they are taking from internet. So an interest rate future is a futures contract with an underlying instrument that pays the interest. So what is there? Interest rate future means here is future contract which with an underlying instrument that pays the interest. So underlying instrument it pays the interest. An interest rate future is a contract between the buyer and seller agreeing to the future delivery of any interest bearing asset. So for interest rate futures is a contract, so it has one contract between the buyer and seller. The 2% will agree to the future delivery of any interest bearing asset. The interest rate futures allow the buyer and seller to lock in the price of the interest bearing asset for future date. Now interest rate futures are used to hedge against the risk that interest rate will move in a adverse direction, causing a cost of the company. For example, borrower faces the risk of interest rate rising. So here futures use the inverse relationship between interest rate and bond prices to hedge against the risk of rising interest rates. So when borrower face the risk of interest rate rising, futures use the inverse relationship between interest rates and bond prices to hedge the against the risk of rising interest rates. Or a borrower will enter to sell a future today. So here the borrower will enter to sell a future today. Then if the interest rate rises in future, the value of the future will fall. Here the link will be underlying assets and the bond price, where hence profit can be made when closing out the future. So what the example is taking here, so I will give here some figures we can take. So firstly, borrower need to face some interest rate risk arising, it is normal. So one borrower is there, you need to face the interest rate risk when it is rising. So interest rate is rising, you need to face the one. And some cases futures uses inverse relationship between interest rate and bonds. So here you are entering in futures now. In futures, for interest rate and bond price will have inverse relationship, they will use inverse relationship, they will edge to edge the risk arising the interest rate. So if the interest rate is increasing, they will go with the low price bond, so it will compensate, the bond price will compensate the interest risk. That is the case. So now borrower will enter to sell the future today. Here, if for example in future interest rate is increasing, if interest rate is increasing, then the automatically bond price will increase. So if it is has highest interest rate, the bond price will decrease. And we can go, and hence profit can be made when closing out the future, when they are buying the future. Or currently some interest rate future segment in NSE, that is National Stock Exchange, offers two instruments. One is future on 6 years or 10 years or 13 years Government of India security, and 91 bonds, that's bonds, that is commercial bonds. So you may go for the long term, you may go for the short term. Now bonds from underlying instruments, not the interest rate. So further IRF settlement is done two levels. One is mark to mark settlement done on daily basis, that is daily settlement, and physical delivery which happens on any day in the expiry month. So mark to market means daily settlement will be there, means at the time of entering into contract they will collect the initial margin. At the end of the day, if there is price changes is high or low, they will collect the difference amount, that is mark to mark settlement. Some cases it may deliver physical delivery which happens on any day in the expiry month, that is the features for this features. And the final settlement can happen only on the expiry date. Here price of IRF determined, interest rate features will determine by demand and supply. Interest rates are inversely related to price underlying bonds. So here we need to identify the two important factors for IRF. So one is conversion factor, another one is cheapest to delivery factor. One that conversion factor, what will the conversion factor explain? So here conversion factor means we have delivery bonds, so deliverable bonds will be there, and we have different maturities will be there, and different coupon rates will be there. So this deliverable bond will have different maturities and coupons. Now we need to make the comparable to each other, so we need to compare all whatever the different bonds we have now, we need to compare. And we need to also with the notional bonds, so some standard bonds will be there, that is known as notional bonds. Here some this RBI government, RBI bank, they may introduce some conversion factor, so they will introduce some conversion factor for each deliverable bond. So we have delivery bonds now, for these delivery bonds this RBI introduce conversion factor, and for each expiry at the time of introduction of the contract is being published by the NSE. So for that we need to multiply, so conversion factor into future price is equal to, and actual delivery price, we will get the actual delivery price for deliverable bonds. So we are identifying this price, actual delivery bonds we have now, this delivery bonds price we are so by using a future price into conversion, that is conversion factor. So here they are explaining about that only. So all deliverable bonds have different maturities and coupons. For that we use the comparable to each other and also the notional bonds. So for that RBI will introduce the conversion factor, and conversion factor to each deliverable bonds and each how expiry at the time of introduction of the contract, so published by NSE. Conversion factor into future price is equal to actual delivery price for given deliverable bonds. Next another method will be cheapest to delivery, so C to D. Here what this will explain, cheapest to delivery means here one bond is there, for example bond is there, the bond will have difference, we will see the difference between what is the spot price and future settlement price. You need to see the difference of these two, spot price and future settlement price. And this future settlement price means which is adjusted with the conversion factor. So we are converted factor is there na, which is provided by the RBI. You need to adjust that conversion factor. We will get the future settlement. So if we see, minimize the difference between this quoted spot price and FSP, this will known as CTD, that is cheapest to delivery. So for that we need to see, cheapest to delivery means is the bond which minimizes differences between quoted spot price of the bond and future settlement price adjusted by the conversion factor. It is called CTD bond because it has least expensive bond in the basket of deliverable bonds. Here CTD bonds is determined by difference between the cost of acquiring bonds for delivery and price received by delivering the acquired bonds. The difference given profit or loss of the seller of the future. Now price profit, when we will get the profit is when we have future settlement price into conversion factor is equal to quoted spot price, you will get the profit. Loss means spot price minus future price, it will get the loss. The bond chosen CTD bonds which either maximize the profit or minimize the loss. Another option will be interest rate option. So we are completed interest rate feature. Now we are seeing interest rate options. So in interest rate options, this also known as interest rate guarantee, which provide the guarantee for the interest rate. Here option we have one right. Option means we have right but not an obligation, and act as insurance by allowing the business to protect themselves against the adverse interest rate movements while allowing them to benefit from favorable movements. So here interest rate guarantees means we will get the right but not an obligation. By get the right but not an obligation means it is act like as a insurance which provide the protection from different adverse interest rate movements. Now it shall be noted that the IRO, that is interest rate option, is basically series of FRAs, that is forward rate agreement is there na, that forward rate agreement which have series. So in forward rate agreement we seen that 4 in 1 into 4 I think so. Yes, 1 into 4 means what we are explained for 3 months, for after 1 month for 3 months loans. So after series means we have 3 into 6 or 3 into 9, this series will be there for FRA there especially. So if say benchmark interest rates are each period say 3 months or 6 months etc. Some of the important types of interest rate options are, one is cap option, another one is floor option will be discussed, and cap option means here the call option, also called as call option. So in call options the buyer, here I think I will off it. In call option the buyer with one person is there na, this is the buyer of an interest rate cap pays premium. So he will pay the premium, pay the seller a premium in return for the right to receive the difference in the interest cost of some notional amount principal anytime specified index or market interest rates. So here buyer will pay the interest, means buyer of an interest rate who is buying the caps pay the seller some premium. Here whenever he pay the premium he will get one right. Here right means but not an obligation, right to receive the difference in the interest cost of principal amount anytime specified index or market interest rises. So cap rates, here buyer will be in buyer bears no obligation, you should not have any obligation or liability. If for example if interest rate falls, it will not bear, the buyer will not bear. The cap will resemble an option as it represents right rather than obligation. Now caps will be evaluated from interest rate guarantee, so they need to pay the fixed maximum level of interest payable floating rate loans. So here what is the advantage of trading? So if you are in OTC, over the counter, interest rates will be there na, that is backed what is the rate is there. Banks may begin some guaranteed rates they will give. So what is the short term, what is the long term, they will see. Here lender will begin to require such borrowers to buy the interest rate caps. So why they will go for this interest rate? To reduce the risk of financial distress. So nowadays the trading activities in interest rate caps has declined as number of new leverage buyouts has fallen. So interest rate caps are characterized by notional payments upon which interest payments are based. So notional payment means that principal is there na, principal we will consider, and after that interest rate benchmark we consider. Interest rate benchmark means we have LIBOR, MIBOR, Sony, SOFR, PLR, different will be there. And cap rate which is equivalent to strike price or exercise price for we need to consider. So for interest rate cap they will consider notional amount, they will consider interest rate benchmark and cap rate and period of agreement. So how much period is there, they will consider this one. So now here we started with cap option. So in cap option interest rate pays seller the premium will be payable for right to receive the difference between the interest cost of some notional principal amount anytime specified index or market interest rate. So whatever the changes will be happen, you will get the minimum interest rate, and the buyer will not have any obligation, no liability to, if interest is false he will not bear any loss. So he will get whatever the amount they want, and they have one some guaranteed interest fixed rate will be there, minimum interest is payable that company will give the at that one. So the interest rate for interest rate characterized we need to use the notional amount and interest rate benchmark, cap rate and period of agreement. Now for payment schedule for interest rate mark cap follow convention in the interest rate. So we are express already the convention means what, convention date means what, convention date means we will consider for all months same dates, 30 days will be considered as for the convention of the company, and payment amount are determined by the value of benchmark rate on series of interest rate or reset dates. So interval between interest rate reset dates and scheduled payment dates typically coincide with the terms of benchmark rates. So if the specified index or interest rate is above the cap rate, if the seller pays the buyer the different interest cost on the next payment date, so the amount of payment is determined by the using the formula. So in forward rate agreement we used one formula. What is that formula? N nominal into RR minus FR, that is reference rate minus forward rate into DTM by DY, that is what how many days is there divided by full year divided by 1 plus reference rate into DTM by DY into 100. We are consider that formula in FRA, whereas in cap option we have formula N nominal amount notional amount into max notional amount max bracket will be open 0 comma R minus RC. R means what is the actual spot rate on the reset date. So whenever resetting the on that reset date what is the actual spot rate minus cap rate. So we need to see the express rate decimal, that is capital rate, and DT by number of days. So DT means number of days for the interest rate, reset date for the payment. So nominal amount into R minus R, that is actual spot rate minus cap rate into number of days we will consider. For example we will see the one example, I think here it is the better. So they providing 1 year interest rate is there. So nominal amount, so principal amount will be, what is the principal amount, $1 million will be the principal amount for example, and 6 months LIBOR rate is provided, 6 months LIBOR rate is provided, amount percentage will be 5% will be the 6 months LIBOR rate. Now agreement will cover from January 15 and with the interest rate, I think today date is 16 na? So we will consider from January 15 to 6 months means January, February, March, April, May, June, July. So up to July 15 it will consider 6 months means. Now first paid cap agreement typically is excluded from the agreement as it is known as date of agreement. Now what is the cap buyer will entitle, payment only for when will you get the cap rate? Only if 6 months labor exceeds the 5%, then you will get. For example, on July 15th, so on July 15th, suppose 6 months labor will be 5.5. so on July 15, then the amount, so we are the rate will be there, capex rate will be 5%, and the rate today is 5.5. so 5.5 minus 5 into notional amount. What is the notional amount? 1 million na notional amount we are taken, notional amount 1 million. so 1 million into difference, whatever the different rate is there na, that actual spot rate minus that rate will be there, into 184 divided by 360 days will be considered for interest rate cap. So here the example whatever we are discussed now, that example will be given. Notional amount will be 1 million and 6 months labor rate is 5%, and when we are entering date, and January 15 we are entered, for 6 months means it will become July 15, and first period agreement will be excluded, agreement date, it is known as date of agreement, and at the time of 6 months labor, the same date, reset date, the rate will be 5.5. so if I need, we need to calculate 5.55 minus 0.5 into 1 lakh, that no amount, into 184 date after the July 15 reset date will be considered. Now another method, so we are completed cap option, another interest rate futures completed. In modern methods we are completed interest rate futures and cap option. Now we will consider the floor option. In interest rate options we are completed cap option, now we will go with the floor option, means it will be down. so in cap option, when increasing now from 5 to 5.5 we will get the calculation. In floor means it will be come, so 5 to below it will come, we need to consider. Here they will explain that one only. Here it is an OTC instrument that protects the buyer of the floor for losing arising from the decreasing the interest rates. So cap option, when will they go? Then we are expecting interest rate is going up, but where here interest rate is going down, then they will go with the floor option. Here the seller of the floor compensate the buyer with payoff when interest rates fall. So here if it is interest rate is fallen, if interest rate is fallen below the strike price, the company will pay the more interest. Where in cap option, if outside the market is interest is increasing, he will pay the outside interest, that is floating rate. In here if benchmark rate is below, the floor rate of the interest reset date will be considered. The same formula will be considered, n into max 0 rf minus rc last time. Now we will see the rf minus r. So here they will come the change, because in last case r minus rc we are consider, now we are considering rf minus r, because here we will go with the low, here we will go with the upper. So when we decided one rate, if the up is there, so the interest rate is went up, then if it is cap option, means cap means upside na, so cap, or floor means downside, so we will consider that one. And next, interest rate collars. So what is this interest rate collars? Interest rate collars, okay, interest rate collars, it is combination of cap and floor. So it is combination of cap and floor. So we need to purchaser of collar buys a cap and simultaneously sells a floor. So whoever purchasing, he will buy the caps and he will sell the floors. So a collar has effect of locking its purchase into floating rate interest that is bounded on the both high side and low side. Alternatively, buying the collar limit the borrower ability to benefit from significant decline in the market interest rates. This is advantage of being less expensive than buying the cap alone, because borrower earn premium income from the sale of flora, the offset the cap cost. So zero cost collar result when premium earned by the selling floor exactly after the cap premium. So by if you buy both options, it will become the interest rate collar. So it is not a solar, it is collar. So both options will be considered here. Whatever the notional principal, actual spot rate, reset rate, cap rate, floor rate, and index rate. Next, interest rate swaps. So here swap means what? Swap means exchanging series of cash flows. It will be swap. So in interest rate swap, what we can consider now? Interest rate swap means if you have fixed rate option, but you are thinking floating rate is better, so we need to swap it. Here interest rate swap, the parties to the agreement term of the swap counterparties agree to exchange payment index to different interest rates. So total payments are determined by specified notional principal amount of swap which is never actually exchanged. Swap dealers, here the intermediary collected a brokerage fee as compensation but did not maintain a continuing role once the transaction was completed. The contract was between the two ultimate swap users who exchange payment directly. Now here swap dealers means with the swap dealers, the intermediary collected a brokerage fee as compensation but did not maintain a continuing role once the transaction was completed. The contract was between the two ultimate swap users who exchanged payments directly. Now what is the fixed or floating rate swap is characterized? Here fixed rate interest will be there, whereas floating rate means it will be variable which periodically resets, so it will be changing by nature itself. And notional amount, here the total interest payment are based on the notional amount only, that is principal amount. On principal we need to calculate the interest. The terms of the agreement and including the schedule of interest rate, reset dates, the dates when the value of interest rate used to determine floating rate payment are determined, and payment dates. Now timing payment, swap is negotiated on its trade date and settlement takes effect 2 days later. Here settlement means T plus 2 days is there. For example, T plus 2 days means you have done the transaction at 1 day and it will take, the shares will be created to your account, it will take 2 days, but in it is USA. Now in India we are following T plus 1 day from February 2020 I think. So from there we are following T plus 1 day, we are planning to T day only. Now we, as per for exam point of view, we need to use the T plus 2 days because they provided T plus 2 day is the settlement date. And price quotation, price quotation means the convention in the swap market is to quote the fixed interest rate, that is as an all in cost. So all in cost means whatever the cost they will add in one rate, they will give the one rate all in cost, which means the fixed interest rate is quoted relative to floating fixed rate index. Next, what are the types of swaps? So in type swaps we have different swaps will be there. One is plain vanilla swap. Here plain vanilla swap also called as generic swap or coupon swap, and it involves the exchange of fixed rate loan to floating rate loan over a period of time. And two, notional principal, where fixed rate basis can be LIBOR or MIBOR, prime lending or rates, different rate will be considered. So we entered at 10%, but LIBOR he is giving 8%, so we need to exchange this one. This is the case. So plain vanilla swap. Here for example, if fixed rate interest is generic swap, each month has 30 days and quoted interest rate is based on 360 days. So for the convention they are taking each month 30 days and 360 days for the year. So in whatever the January or whatever the month February, if it is February 28 date per, we need to consider 30 days because they are following the convention. And here the semi annually fixed interest rate will be whatever the amount, the nominal amount into AIC rate into and 180 divided by 360 if it is 3 months. Next, year whatever the N denotes notional principal, AIC denotes fixed rate, and whatever the amount of, or basis rate swap. So basis rate swap means it is non-generic swap. Here similarly plain vanilla swap with the difference that payment are based on difference between two different variable rates. So in normal vanilla swap fixed rate versus float rate, but here both are variable rates only, but different markets will be there. It may be 1 month LIBOR and offer for 3 months LIBOR. It is two legs of swaps are floating but measured against the different benchmarks. Another swap will be asset swap. Here asset swap means like plain vanilla swap with different, that is exchanging fixed rate investment such as bonds which pay guaranteed coupon with floating rate interest investment as indexer. Next, amortization swap. Here amortization swap means an interest rate swap in which notional principal of for the interest payment declines during the life of the swap. So they are particularly useful for borrowers who have issued redeemable bonds or debentures. So it enables them to do interest rate risk hedging attached with the redemption profile of the bonds or debentures. Next, swaptions. Swaption means what? Swap plus options is known as swaptions. So swap plus options means swaptions. An interest rate swaption is simply an option on an interest rate swap. Here we have both. One swap means exchanging the cash flows. Option means we have obligation, we have a right, we do not get the obligation by paying the premium. So both will be provided in one. Here interest rate swaption is simply an option of an interest rate swap. It gives the holder right but not obligation to enter into interest rate swap at a specified rate in future at particular fixed rate or fixed terms. Here we need to consider two types of swaptions will be there. One is fixed rate payer swaption, that is called as call swaption. Give the owner of the swaption the right but not obligation to enter into a swap where the pay fixed leg and receive floating rate. So fixed you need to company will to pay fixed and receive floating. Whereas fixed rate receiver swaption, here fixed rate receiver swaption ante the person, it is called as put swaption. Here the owner will get the right but not the obligation. He will get a receive fixed in leg and pay the floating leg. Now the principles of features of swaption. So what are the principles features of swaption? It has principles. One is the swaption is effectively an option on forward start, that is interest rate swaps. Here where exact terms such as the fixed rate of interest, the floating reference interest rate and tenure of IRS will be considered established upon conclusion of the swaption contract. Here 3 months into 5 years swaption would therefore be seen as an option to enter into 5 years IRS 3 months from now. Next, option period. You need to consider the option period. Here option period refer to the time which elapsed between the transaction date and expiry date. Swaption premium is expressed as basis points. So swaption premium, whatever the swaption premium is expressed as basis point. Swaption can be cash settled. Therefore, at expiry they are marked to market. Marked to market means it is daily settlement of to applicable to forward curve at the time and difference is settled in cash. Now pricing of the swaption, how it will be pricing in swaptions. In swaption, pricing methodology depend upon setting up a model of probability distribution of the forward zero coupon curve which induce market process. Here we need to use the swaptions. How can we use the swaptions? Swaptions can be used as a variety of ways with how both active traders as well as corporate treasurers, and swap traders can use them for speculation purpose. Speculation purpose means here we will get the profits. We will not buy the asset, we will not sell the asset, so we will take the net position. So that is speculation. And hedge position. Hedge position means to manage or to mitigate or to prevent the risk, we will go for the hedging. And swaption has become useful tool for hedging embedded where optionally which common to natural course of many business. Hedging means which how host to contact, for that host contact which embedded one additionally asset, it is optionally provided. Whereas options are useful to borrowers targeting an acceptable borrowing rate. So they will take where the borrowing rate is acceptable. If it is the borrowing rate high, they will not accept. Whereas options are useful to do business tendering for contract. So they will use the tendering means offer bidding. They will use these swaptions. Swaptions also provide protection on callable or puttable bonds issue. Callable means company will get the right, puttable means buyer will get the right. So they need to pay the some premium amount to get that right, but they will not get any obligation in that call option or put options. This is the interest rate risk management.